Hi everyone, welcome to where I have always wanted to see you, doing the financial analysis. Honestly speaking, this topic is the reason why you're looked at the entire course. And I swear, if God had given me a chance or a way out to teach you this particular concept without making you go through all the pain, I would have definitely chosen that path. Remember, in the first class, we spoke about one of the authors judging a dance show where we said something's not right. And I said that tomorrow you'll have to judge the financial statement of an individual or a company. And at that moment, you would be faced by someone who knows the rules of accounting too well. So, to save yourself from disgrace on that day, you have to go through all that pain. So, congratulations that you have already gone through all that pain. And it takes a lion's heart to be able to absorb all of that, more particularly for non-commerce students. So very well done. But as they say that well begun is half done, I must tell you that it is only half done. Well begun though, it's only half done because the meat of the course, which is the analysis of the financial statement, that is something which is still pending. So people, welcome to the analysis of financial statement. I want you to get to a frame of mind where you have to judge someone. Okay, I was able to capture this nice picture uh, where you're not going to believe everything that is, shown to you, produced to you. You're not going to take things on the face value. And that is the right frame of mind for an analyst, for a manager who is digging deeper into the financial statements of a firm. And as a golden rule, while we were doing our CFA, the golden rule taught to us was always be skeptical. Now, skeptical is not a cynic who has to disbelieve everything, but a skeptical is someone who doesn't take things on the face value. There is a curiosity, there is a need, there is an innate desire to get to the next level of what's happening. So again, connecting back on one of the accounting principles of substance over form, please try and find out substance as much as possible. In the live class, we're going to have a wonderful case through which we are going to look at the analysis of a particular financial statement. But before that, I wanted you to appreciate the overall mind map. Congratulations that you have come a long way. We started with some basics of accounting, some presentations into balance sheet, income statement, and cash flows. And finally, I said that you are here. So to be able to do step number 4 well, you must understand step number 3. To be able to do that, must understand step number 2 and therefore step number 1. So the understanding of business here was super critical because at the end of the day, I need to get judgmental about things. Who can analyze, let's say, what are the different stakeholders from a business standpoint? It could be a banker wanting to find out the credit worthiness. It could be an entrepreneur, a startup promoter, or a co-founder wanting to find out the business viability. You've done all of that. It could be a shareholder wanting to find out returns on investment. It could be a supplier wanting to find out the liquidity position. Could be a customer. I remember we taking Maruti versus MRF example. So here MRF is going to analyze Maruti Suzuki's account, but at the same time Maruti Suzuki will also analyze MRF's account just to find out whether they can catch up. So the sustainability of operation was something that we were very, very careful about. And then capital market finding out corporate governance, then government finding about the revenue generating ability. So the taxation comes here. Okay, the employees trying to find out the impact on wages and salaries. And at this point, I remember telling you that it could be both a positive impact, that if the sales have gone up by 30%, profits have gone up by let's say 30%, how much is the wage increase? On the other hand, the employees of BSNL and Air India were also worrying about if the sales have crashed by 50%, what's the impact on the jobs and the salaries. Okay, we've done this as well. So I'm extremely happy that now, is really where the ends are meeting again. We said there are broadly 6 steps in financial statement analysis to first define who we are, gather the data, process that data, analyze the data, report the data, finally your conclusion, and update. We have made the point at that point that 5th and 6th is an optional step depending on who you are and what you want to do. But generally 1, 2, 3, 4 is important. And the most important step is, why are you wanting to analyze? Who are you? Which has been well answered in the previous slide. Gathering the data is a step, like I said, there are multiple sources, newspapers, financial statement, company's website, annual report, third party, research reports, etc., magazines, trade journals, etc. This is what we are going to learn in this particular class, financial statement analysis. How do we process the data? And that's where a lot of tools are going to come into picture. Okay, we're going to talk about the tools. Once the tools have done their job, we are going to apply our mind and start answering the question that we had asked on the first stage. That's broadly the financial statement analysis, people. What am I trying to find out? These are the 5 aspects about the financial health of a company. Activity on a day-to-day basis. How is business being run? For BSNL, let's say, clearly not a great idea, clearly not a great performance as far as activity is concerned. Not many connections getting sold, not many new customers coming up, not able to make the payment, blah, 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 and all of that stuff. Okay, that's activity. On the ground, how are you doing? Liquidity, on the other hand, is the ability to pay their short-term obligations. So here, short-term obligations was important, where we said it doesn't matter it is operating obligation or it is financing obligation. I don't care about it. And we've done the profiling of liabilities on a 2x2 matrix. So here, I'm going to pick up everything which is short-term. Then we spoke about the capital structure aspect, wherein we said it could be the debt which is creating pressure on the capital structure, being an inflexible form of finance or inflexible source of capital. So let's measure that up. And here, largely the ratios are focusing on debt. So, we will come to the ratios, but generally every ratio would have an aspect of debt or let's say interest, which is related to debt again. So a classic case of companies which have not been able to handle debt that well are Jet Airways and Sahara. If you look at the balance sheet, the debt has been continuously going up. Why debt is going up is also another interesting story. But what these ratios, these 5 contours or 5 individual silos tell you, that this is the point of the problem. The reason is something that an analyst, you and me, will have to dig as to why did Jet have to borrow so much money. What went wrong? Now that's where the probe, the curiosity, begins, and that will make you a good analyst versus an average analyst. We then spoke about profitability ratios. Let's say in context of automobile industry these days is extremely bad. Post-COVID situations, cyclical industry, huge fixed costs, like cement industry for that matter. These are all very high fixed costs. Steel industry. The moment there is a slowdown in the economy or particularly in the industry for whatever reason, these industries really are in for trouble. So profitability ratios, we've done that, calculated by the management, where it is calculated in reference to sales, and the capital provider, which is calculated in reference to the capital that they have contributed. And I also made a point that profit is not equal to profitability. Profit in relation to a base, that's profitability. So you need a denominator. Numerators are going to be different levels of profit, gross profit to net profit, but the base is something that you got to change according to the perspective here. Valuation ratios, you can talk about a lot of stuff like price to earning multiple, EPS, and things like those. I didn't really focus too much upon the valuation ratio so far in any of the previous class, nor do I want to do that, in this particular module, because this, I believe, is a little more elective oriented. That's not the core area of a marketing or an HR or an IT or an operations guy. So I would want to reserve it for your elective course should you want to take it tomorrow. But just have a broader sense about things, that whatever is the company doing in any of these four, one, two, three, and four boxes, will ultimately have an impact on the perception that an investor is going to have on the company in the stock exchange, in the stock market. So that perception, the relationship between the actual things done, the business, and the perception is what is captured by these valuation stroke investment ratios. Very interesting, to study. Welcome to the tools of analysis. Broadly, there are four tools, out of which we are going to practice, in fact, all of them through our case. Ratio analysis is a numerator and a denominator, a combination, a logical combination of two variables. Could be profit and sales, could be debt and equity, things like those. So there is a bar that separates. One is at the top, the other one's at the bottom, called as the driver of the ratio, called as the base of the ratio. The faster the driver drives, the ratio moves faster. So a numerator has a positive relationship with the overall ratio. Denominator, on the other hand, has an inverse relation. Fatter or larger the denominator, slower the ratio. It's like a break of a ratio. Time series analysis, we're going to do that practically, on the Excel file in our live class. Time series analysis is measuring the performance of a particular parameter. Let us say inventory. How much inventory do I have today vis-a-vis last year, vis-a-vis the year before, and that's how. So my objective is not to compare inventory with fixed assets. My objective is to compare inventory with the inventory of the previous. That's the time series analysis, people. A common sizing, or also sometimes called as the cross-sectional analysis, is where you're comparing two different companies. We are going to talk about that a little more when we, are going to come to the Excel file, the real case. But broadly speaking, where two companies are of different sizes, it's very difficult to justify that a smaller company can also be better managed company. If you look at the absolute size of the profit, obviously the larger companies like Reliance, HUL will always score much above in the smaller companies. But that doesn't mean that in terms of the performance, they are badly run, the smaller ones. So you need to common size, equate the size, assuming everything is equal to 100, both the companies, and then restate the entire income statement and the balance sheet. That exercise is common sizing. We're going to come to that, in our live classes through that, the case that we're talking about. And graphing and charting is something very simple. It's more of a presentation tool, and sometimes it's immensely helpful for analysis as well. Key profitability ratio, I'm absolutely no mood to go through them again. Just a very quick refresher. Calculated by management, have sales in the denominator. Calculated by the capital providers, have different levels of capital. So you can have return on capital employed, where equity plus debt both are sitting. Only return on equity, that means only the capital provider. And at that time, we had said that you have to maintain the parity between the numerator and the denominator. You have to maintain the parity, that if the denominator is only equity, then you have to also take the profit which belongs only from generated for equity, which is PAT, not EBIT, because EBIT is owned both by the debt and equity as well. We spoke about liquidity ratio. We said if the denominator is current liability means operating plus financing both. So a short-term bank loan will also come here, and outstanding salary will also come here. That's what you got to pay. And numerator is the pool of assets which are available to make payments. We said if you have 1 full year, use all current assets. If you have just, let's say, a week to make payment, or just, let's say, 3-4 days, you will not be able to use your inventory and account receivable. Just take cash assets here, cash, bank, and some very short-term investments. If you have roughly about 3 months, use quick assets, which means all the current assets except inventory and prepaid, which means essentially your cash plus bank, your short-term, very short-term investments, which you can liquidate on a day's notice, and account receivable. These are your quick assets, people. That's the numerator. You see that in all the cases, 1, 2, and 3, the numerator is slowing down, is gradually reducing, and the denominator stays where it is. Solvency ratios, pressure from debt. Debt to equity, one of the most important ratio to measure the risk part. More the debt to equity, more the risk. Is it good or bad? We're going to debate in the live class. But long story short, some amount of debt is still required. To have zero debt is a policy which is risk free. It's not the most optimal strategy. Okay, there's a difference between zero risk and most optimal risk. Okay, little bit risk taking is important so that you can propel yourself. Interest coverage ratio, that's the pool available from which you got to pay the interest, and that's the denominator. Again, it's sort of a coverage ratio. 5:1 means for every 1 rupee that you got to pay, you have 5 rupees of pool. You're safely covered. Activity ratio, little more irritating than the other categories, a little mixture. So you have the turnover ratios, which are always trying to utilize the effectiveness of different levels of assets in generating the sales. So you have this numerator, you have this denominator, and the ratios coming out in times. For 1 rupee invested in the total asset, 4 times is the sales generated. Higher the better. And the others are for what time, collection period, for how long does it take you to generate your the cash from the credit sales. How long does it take, inventory holding period, how long does it take for raw material to convert it into finished product. The addition of the two becomes the operating cycle. Shorter the better, because every business wants to have multiple cycles and shorter ones. Supplier payment period, how quickly do you make payment to your suppliers? Again, a debate. How long, how short is good? Very short means you got to pay your suppliers very quickly. Not a good idea, because you have to pay the cash that quickly and therefore you have to part with it. Very long is also not a great idea, because that means that your good suppliers won't work with you. All of that, the business side of that, you're going to learn in your corporate finance under working capital management. So just take that, from me, working capital management, hashtag corporate finance. Because that's where the debate and the decision making happening. Here we are, so to speak, the whistleblower, that here is something which is wrong. Why is that wrong? We got to check with the corporate finance manager. People, I'm almost towards the end of this overall paradigm, and on that I would like to bring to your notice a very critical piece of information. And I'm going to take a example from your common life. Imagine in your course on financial accounting, out of 100, you scored, let us say your score is 72. Now tell me if it is good or bad. Well, depends on, as you're rightly thinking, on whom do you want to compare yourself with. Your actual could be compared with multiple things. For example, your own previous actual. Let's say this is a postgrad, and in your undergrad, you had gotten 85. So your parents are going to think that you're not working as hard in your MBA or fellowship as much as you've done in your undergrad. That's one way to look at things. The other way to look at things clearly is the average of the class. In MBA itself, let's say that average of the class is 60. So compared to your overall class average 60, you've got 72. Well done. Very well done, in fact. Other could be the topper of the class. Now, topper of the class perhaps have got 95. Compared to the topper, you've got 72. So that tells you how much is the potential for future improvement. You see, so you continue to change the reference point, and the quality of analysis, the judgment will also sometimes change. Are you good or bad? Depends on whom am I comparing with. Please apply a lot of intelligence while arriving at the reference point. Spend good time. It's not that, because what you've done is 50%, and with whom you're comparing is a balance 50%. You can't really focus only on your performance. You have to also, measure it against a reference point. Now, what all could be a suitable reference point, as we have discussed? Some of them. A peer group, typically, let's take an example. Let's take example of, let's say, Samsung. In one of the classes, we have taken the example of Samsung. And Samsung, typically the vertical which, make mobile phones, handsets. Now, specific competitor could be, let's say, Vivo. So Samsung is very closely aping what Vivo is doing. I don't know, it's a hypothetical thing, and therefore that's where Vivo's financial statement will be analyzed in threadbare to make a comparison. It could be the overall industry, which will include Vivo, Oppo, Lava, and let's say there are and of course Apple, Xiaomi, and there are many. So let's say roughly about 10 players. But sometimes you tend to believe that all the 10 players are not the right reference point, because let's say Lava operates in a sector or in a price point where your Samsung does not. So you would want to exclude such non-relevant players, non-relevant competitors to come at a relatively relevant competitors. That's a peer group. So let's say in context of Tata Motors, Maruti is not a good peer group because Tata Motors largely derive its sales from commercial vehicles, about 65%. And therefore Ashok Leyland and Mahindras are better peer groups. You see, so while Maruti will get included here in the industry average, Hyundai or Toyota will get included here in the industry average for Tata Motors as a subject company, but they will all be excluded here. Let's say Honda, not a good parallel with Tata Motors at all. Okay, that's it. And the own historical, right? So people keep these fewer things in mind, and I'm very sure that you're going to really ace this module as well. I am super excited to meet you in the live class. There is a case that we will discuss. I hope that you have already gone through it by the time you're looking at it, or you're going to do that very soon. In any case, just think about one thing every time, that the analysis is why you had taken this financial accounting as a module. This is really the final Mecca Medina of the financial accounting. This is why a manager is taught about everything to anything that we've done in the course. I invite you to the live class with a lot of hope, with a lot of curiosity. Thanks very much for watching this. And again, congratulations for really coming towards the fag end of this course. Thanks for watching.